Hi, everybody. Thanks so much for taking the time today for such a fantastic topic as tax. I know all of us certainly look forward to tax every year. My general comment to everybody is usually the government should pay me for doing my taxes, but I digress. Today we're going to talk about taxes and how we and you guys can use your tax return as a tool, and really how the accountants as well use your taxes as a tool to actually better your understanding, but also better the operation of how you use it for banking, for your life, for planning out things that you want to do in your own planning. So the first thing that I want to get into, because of course we're in the last 2 days of tax season. So we often hear from people, geez, they're not getting back to me. Just consider most accountants, we always say to people, most accountants have 3,000 to 4,000 clients. Some firms, like bigger firms, have over 10,000 clients. So I know a lot of people think it's just very boutiquey and, accountants only take a very small amount of clients. That actually is never the case. So even though the Tower Group is a boutique firm, that's why we often say, come to us first if you have a question, because a lot of times we can ask the accountants, we understand the tax lingo. And when you kind of look at the tax lingo over a period, accountants can usually answer stuff for us in about 2 minutes flat, and we understand it. For a client, that might take an hour. So sometimes, if you ask us the questions, we can ask them quickly and get back to you and spend that hour with you if we needed to spend that hour with you. And that's something that I always say in the last 2 days of tax season. If you have questions, if you have worries, if you have things going on in your brain, please reach out to us and let us know what those are, because again, we are absolutely open to answering any of your stuff and trying to help you through the accounts as well. The biggest thing that you need to know is that if in fact your accountant has downloaded your taxes to your accounting portal, every accountant nowadays has what's called a tax portal online. If you're one of those ones, like let's say my parents, that they need to go in and talk. I've had to set my father up now with an online account, because every firm doesn't want 4,000 clients coming in to sit down, talk about their taxes in the last 2 days of tax season, and sign them in person. So make sure that you have your online portal set up, you know how to use them. If you don't know how to use them, you've asked your kids how to help you use those tax portals so that you can actually sign your taxes. Because what we saw last year is actually, which, is a terrible number for the Tower Group, that 10% of our clients actually never signed their tax returns. And so accountants didn't file them because they were like, well, you hadn't signed them. And then people were angry that first day. And why has my taxes not been signed? Why have they not been sent off? Well, you need to sign your taxes and you need to take responsibility for your taxes and do that yourself. Because although we all try to help everybody, we can't do everything for you. So you do have to take that responsibility.
And typically, Pam, like all these accountants send the email out, here's your link, taxes are ready to be reviewed. I might be telling you things you already know, but it just bears repeating. So you're in that portal, and typically it's under a documents to be signed folder. It allows you to go through it and review it electronically, and it just has a sign here, electronic signature function. And then that allows it to go back to the accounting team for them to file. And just to add what you said there about meeting with accountants, Pam, like obviously they're totally available for online and in-person meetings, but typically that's in March or early April. And in many, we suggest absolutely, like at least every 3 years, you're in front of that accountant, or we can involve them in an online meeting. But just a lot of them have a hard, fast stop about April 10th or April 14th, and then there's just no like in-person communication much for regular meetings, and then it picks back up in May.
Yeah, so the thing that everybody should know is CRA, as you guys probably read my great budget that I sent out via email. If you haven't read my budget, go to my budget, because it took us a ton of time to write, and it took us a lot of effort reading through a book that's this thick on the budget details. So make sure that you read them and some of the tax changes. What we've tried to pull out is what the tax changes are that were really serious for people. And the biggest one that I think people should know is your penalty for being late. If it's your first time being late, they're going to charge you 5% as a penalty of whatever you owe, plus 1% per month that you owe it. That's just the penalty. So you also get charged interest. So interest this year is 9%. So if you can imagine, as you kind of see that 1% plus 9 equals 10% of your money, if you owed them $1,000, you're paying $100 a month for that $1,000. So don't be late. And of course, if you've been late a couple times because you're like, stuff's happened, I was away, or whatever reason, don't be away on the last day of tax season to get your stuff filed or get it done before you go away. If you've been late more than once in the last 2 years, so adding this year, so 3 years out, if you've been late more than once, they're going to charge you an automatic 10% of what you have owing as a penalty, plus 2% a month, plus the 9%. So as you can see there, it's almost 11% plus the 10% of the amount owing automatically. So almost 22% of what you owe is going to go straight to CRA as penalties and interest. So don't be that person that does that late. If you owe more than $5,000, they're actually going to charge you an automatic $250 on top of it for the first day, and then charge you above that every month you go. So make sure, again, if you're somebody who owes a lot of money, don't owe a lot of money, and make sure you come to us or your accountants prior to say, where am I at from an accounting point? And that comes back to as well, if you are running a corporation or you are doing personal, and we often ask people, what did you make this year? And people are like, I don't know. We're going to spend a lot of time on income today because you should know. And you should know what you make, and you should know where your T4s are sitting. You should know where everything is. And again, we're going to talk about why you want to know that and why you want to be really sharp on that one point. If in fact, let's say you forget, sometimes people go, oh, I have this medical company that pays me occasionally personally. I might have this. You can't, I might. You have to know if you got money personally. Know that, write it down, load it up to your portal if you have to, write it on a piece of paper. I always say to people, bring note paper every time you do your taxes so that you can write down for yourself, I got this money from these people, I'm expecting a T4. If you don't report that T4 for any amounts $500 or over, they're also charging that $250 penalty plus that 10% that you have in the point above. They're charging all of that just for the fact of if you have a $500 T4 that you forgot to put in. So you're almost paying more than half of that $500 you got paid to CRA right off the bat.
And the government is becoming more strict and penal with a lot of these fees, and looking, what I would say is they're looking for every nickel in terms of audits and reassessments. I think just because of more of the deficit spending, they're looking to generate more revenues. So that's why. But then just to relate back to installment interest and penalties, so if you owe more than $2,000 in any given year, you get this letter that says, okay, we want our money in installments through the year next year. And they're assuming your year is going to be the exact same as your previous year. Note that a lot of these letters are no longer letters, right? They're communicating to you through the MyCRA portal. So technically, like what I would do for my own installments, I don't do 3 or 4 installments that it says through the year, but I definitely pay everything I need to pay. So if my income looks exactly the same as last year, Pam and I just make that payment in September and then December. If your year is dramatically different and it's half of what last year was, that's why you've got a financial planning team that's backstopped with accountants, and we can help forecast what your assessment and installment would be. And then I personally think you make that payment in September 15th and by December 15th. Interest for overdue remittances. So if you're an employee and you've got a pay stub and they're automatically remitting for you, that already happens. If you've got your own company and you've got your own salary and you're doing your own payroll remittance for yourself, or you've got a payroll company for your team, A lot of us are less than 7 people on your team, so you're making that payment online every month. So Pam's been guilty of making a mistake once or two over the many years and paying on the 16th, for example. They charge you a few $100 for every time, for every instance. So a lot of times, if that, and that's also why we say pick a salary level for the whole year so that's even and consistent every month to make it easy on yourself, as opposed to changing, like let's say you changed mid-year for some reason, then we can help you get a new payroll remittance sheet or a new pay stub, for example, in that moment, so you know what to pay for the next month's 15th of the month. But you can pay on the 10th, 12th, or 14th is a wiser alternative, so you don't have those significant overdue remittance fees.
And your accountant can provide those remittances at the beginning of January and run you through the year. But like Kelly was saying, is sometimes there's payroll adjustments that happen, and that always usually happens in June. So you should actually reach out to the accountant in June of every year and say, hey, what's the new payroll remittance, regardless of your year ends. Payroll always changes in Canada in June for July. So you always want to make sure that you have that available to you. And some people just continue to pay for the December, and it's usually a little bit higher. So you usually end up being okay, but just make sure that you know that there are sometimes changes from the government, as we've seen, that can happen more than twice a year. So just make sure that you get that sent to you if you're not doing payroll through a program. And we often recognize you can do that too if you wanted to. There's lots of programs out there, a lot of payroll providers too, that you could hook up with to do that stuff if you wanted to, if it's out of your wheelhouse. So, what would be a Tower Group presentation without my Kermit the Frog slides? So, I always say, taxes, just like anything else that people are overwhelmed with, it becomes a part that either people are going to ignore and just hide from, right? And it's like, maybe if I don't see it, then it won't happen. You hear on the news every day that, lots of people aren't filing this year because they're afraid of the tax they're going to owe. Well, now that you know the penalties, that's why you don't want to do that, because it's going to be a nightmare. They're now actually even recalling people who have moved out of the country and owed people money. They're actually trying to get tax money from all of them that have left the country and still owe the money. So you can't really hide from them. And of course, they're first right of payer on every situation, even on this state. So know that they will get their money come hell or high water, as they say. So you can be the same person too that might be, hey, you got such a huge tax bill, you're going to sit and drink or you're going to freak out. We often say it's a calm approach to sitting down with your accountant, finding out what you're actually looking at each year. Again, part of the Tower Group services is we offer that meeting with the accountant anytime that you guys want it throughout the year that's not core tax season. We will definitely have that meeting with you and be able to explain some more things in regards to your plan with that. It's much better than sitting down with Gonzo at the water cooler saying, I just don't understand this. I don't understand how this is all happening. And I heard CRA is doing this. And some people say, oh, you can do this with CRA. And sometimes you really can't. So take the hand of someone who's professional, make sure that you understand. I've had lots of people get information from banks, from other people that they work with. It's wrong. And if you wanted to research stuff yourself, go look on canada.ca. And again, that's the tax resource for everything. And they've got pretty good at the Google search line where you can find out that information.
Yeah, and taxes are unavoidable, but I like to think that we can try to help you optimize your tax return and manage it, and then just try to make sure that you've claimed every deduction and every credit and done everything you can in applying strategy, because tax affects all of the aspects of our work, and we'll help you through it. And then ideally, we're going to engage you more on a go-forward basis through good conversation, but we're already using your tax return as a tool, and we'll just loop back to you and use that method to say, okay, proactively for the next year ahead, what can we be doing through the year?
So, for the last 4 years, actually almost 5 years, we have sat down, even when we were at the office, we would offer tax sessions, and we were telling people on a piece of paper to open up My Account. Now CRA is actually moving online with My Account. So if for the last 5 years you haven't done My Account, is what it's called on CRA's website, you need to make time. We all have the same amount of time in a day. And of course, I often hear from people, I just haven't had time. I haven't had time to do any of this stuff. And it's like, you need to make this a priority. You need to find the time. And you need to find the time that if you have a corporation, you also have to sign into My Business Account. Any address changes now, any bank account changes, they're all done online. And all your communication now is also online. For 1 year, they still sent out all the communications in the past year, but the majority of the communications all went online. So make sure, because a lot of people kind of assume that we get them, which we get none of your communications, just to be clear. And unless you send it to us, we don't get them. And all the accountants actually don't always get them either. And if they get them sometimes a week after you get them. So because they're phoning and saying, hey, we're following up with this notice of assessment we put in, or this notice of objection that we put in, and make sure that you're checking those. So we often say 3 times a year, CRA will send you an email and say, this is in your portal based on this. So they'll say payroll or your personal taxes or whatever. They won't give you details. They won't say, hey, click this link to go there. They'll just say, hey, this is in your portal. So
Yeah,
don't
Pam.
get caught in a scam that way.
Yeah, so even if I ever saw an email like that, we would still delete the email without touching anything inside the email, and then independently go and enter our own portals. They'll never text you. Once in a while, they may phone call you, but then we take the information from that person potentially calling, but we say, we'll call you back, or we'll call CRA directly, or we'll look in our own portal. So don't get caught giving any information away by a phone at all. But yeah, access that portal once in a while. And it actually is a really good tool. There's good material in there, references, calculators. It's interesting. Or if I need my notice of assessment, I can use it to go and grab that. But I'll turn it over to you, Pam.
Okay, next. So obviously, we always say, know what you do. So if you're in the medical field and you're on this call today, I don't even profess to know anything about medical. And the stuff that I'm learning now that I'm getting older, I'm learning, but I think I know about this much. And I think I often hear from clients, and hence why I say this, I hear from clients is I need to understand everything to do with the tax code. I really need to understand everything to do with this. I need to learn everything, which if this is your hobby and you want to actually learn everything, the tax code is called the tax code for a reason. It's called the actual Canadian Tax Act. The Canadian Tax Act is about this thick as the books each year. Again, same thing with Canada.ca. They try to do their best to update it. Some things will say, hey, this is archived and no longer here, which means that rule is no longer in place. This stuff changes all the time, and we even have to go to so many sessions to learn about all the changes. And like I said, even with the budget, you're reading massive documents to try to go through and have this information for your clients. That's our job. That's an accountant's job as well. Accountants know this stuff even better than we do. So we say ask the questions and spend the time, because that's the most important thing, is get the information that pertains to you, because chances are, that's the best way to understand it.
And with a question, we can often provide an executive summary or an article, or a lot of people appreciate my just quick bottom line, here's what you need to know, or can you forget this area and your people are on it. But we also pride ourselves in all of our connections with you to bring customized knowledge relevant to your situation now, and even over the next 3 or 5 years, we'll give you an advanced peek at some things that you should know, and we'll help you understand some of it.
Okay, so we're going to move a little bit faster now, because we recognize the fact that this is going to take a lot of time. We have a lot of information, so we're not going to add in on every slide here, but we do want to try to move through as quick as we can and also answer as many questions as we can. So we do recognize that we might go over time. If you need to leave, feel free that you can. But we'll try to get through this as fast as we can and give you as much information as we can as well. This is a sheet that all of you guys should have seen in your lifetime. The Tower Group has sent this sheet out for the last 9 years to all of our clients. So if this is new information to you, you have to start reading our emails and making the time to do that. So why we send this out is so that people actually recognize what the income tax brackets are each year. Maybe you might not care until it comes to tax time, and then you might go, well, oh, okay, I didn't really understand the income tax was all of this. This changes almost every year and has immensely since this government change, more so than ever before. So what the basic things you need to know is, as you're seeing in the federal income tax bracket, there's a personal exemption on the bottom that's $15,706. On the Alberta's income tax, there's a basic personal exemption of $21,000. If you add those numbers up, that's your personal exemption amounts. So what that means is you can receive income up to that level with paying minimal tax. And that's your minimal income tax bracket. When you combine the federal and Alberta income tax brackets together, you can see where your income tax bracket is. So when someone comes to us with an RSP or with, hey, what are you going to do? What us and the accountants always ask you for is, well, what's your income? What was the amount of income you took? Well, I think I took this, or I think, and again, I want to spend a lot of time on income. You need to know what that number is. So look at your pay stubs. People are like, I don't even get them anymore. Get them once in a while, or ask for your year-end one, or ask your employer to provide you the T4 early, or if you can get the accountants, if you're incorporated and you've got your December done, get your December done, because of course they all have to provide T4s by February. If you can get them done in December, then you know that number. And you should know that number just from the pad of paper that you have and all the dividends that you've taken out. If you're incorporated, and the salary you've taken, you should know that amount. And what that does is says to me, do you need to max out your RSP, or do you need to do a certain amount? We look at these tax brackets on the combined amount and say, hey, does that $1 difference, like let's say you were in that $55,000 bracket, that $55,000 bracket, the next $1 is what you get taxed on. And of course, would that $1 in an RSP make a big difference? Yes, it would, because that's 5% extra on your taxes that you're going to pay. So it's like, am I going to say, yes, you do RSPs for that, or let's break down an entire tax bracket for that extra income? Yes, I would tell you that too, because of course, that's when that makes a big difference, is when you're going down a tax bracket. That's where we come up with those numbers. And of course, it's very important to look at that. A lot of people too say, well, how come I can never get over $31,000? So that 960 there, that is the maximum RSP you can get, regardless of if you had a $500,000 income. So that's where that number caps out. And it's always good to know that capped out number too of, we get a lot of questions, and the accountants get a ton of questions on that too. So when we talk about income, this shows you an example of someone's income tax return. So this person made $304,000. So you go, okay, what other kinds of income can be placed on here? You see, obviously, that person at a $304,000 income is top tax bracket. So that's why, this is a good income tax return to think about. If you're top tax bracket, you can also see this person has $75,000 of rental income. When you're actually in a top tax bracket, or even when you're, intermediary, we often say same thing with business income, same thing with farming income. If you have farms on this, you have commission income, or let's say you're making income personally from a medical company, make sure that you're calculating in what's the minimal amount that I can take, because you don't want to be making money on any kind of rental property or self-employment income, because of course every dollar of that is going to also get taxed at your top tax bracket with this income that you're also making. And as you can see, there's many different types of income, which we'll talk about next, but there's many different types of income, like even dividends on here, CPP, there's EI mat leave that a lot of people experience on here, other employment income, RSP income that you might take off your RSPs, first home buyers accounts on here. And then the next part of the tax return, you'll actually even have investment income. So let's flip to that. So all these things are income that you can control. So sometimes you might have a salary and you say, hey, you know what, I have no control over that. But let's say all of a sudden you take a mat leave and you're halfway through your mat leave, because of course I put on EI and mat leave on there. Sometimes you might lose a job midway when you had a job. Those things are things that you have to control, because all of a sudden you hear what's called a clawback. So that's where they claw you back money because you haven't controlled it, or you've taken out too much money in the beginning and then you claim EI. You have to know that those max out as well. Splitting RSP income. So we often say, sorry, let me go to that. So RSP income, we obviously say, you know what, if we're taking RSP income, you could in retirement, let's say you retire earlier than 65 and you have no other sources of income, we usually can take out, as you see that personal exemption again that Trish just flipped to, you actually can take out a small amount. So let's say $31,000 you want to take out of your RSP. You can take that out, pay the withholding tax, and actually get it back on your tax return if you have no other income. So that's when we say that is super efficient, that you're taking out your RSPs tax efficiently without actually having to pay the massive 45% RSP income tax that you'd have to pay on a big withdrawal otherwise.
So let's say you were 64 there all the way through retirement. Our goal will be to help you equalize your tax bracket with your spouse every year as you go forward. That's partly what splitting pension income means.
Yes, and so if you have a pension, you can split that pension. Some RSPs you won't be able to split until it's a RIF. So of course that's super smart to know, is saying, well, now this becomes pension income. How can I split it? But again, you want to look at the income tax return of the other. So we've often heard in our career, well, you know what, my husband does his accounting somewhere else, I do my accounting here. We look at their tax returns, it doesn't even report income close. You know, sometimes it doesn't have, you know, what the other person's doing. There's no split income. You're not saving tax. Do your taxes in the same place, because this is one reason why you want to. If you're going to do them yourself, do them together. You always want to have equal amounts of income, because otherwise, if it's doing this person's paying more tax than the other person. So really great to know. That's a great idea, Kelly, for sure. Those who have professional corps, you know, make sure that you can control your salary and dividend split. And we'll talk about dividends, because dividends tend to be a confusing thing for people. So we'll go to that in a few slides. But just make sure you're able to even those out. We have already kind of talked about the rental. We'll jump to the rental as well in a couple of slides. And then self-employment, you know, like we talked about, is making sure that you're using the possible deductions that you can use. So rental expenses, I just wanted to show you quickly. This is an example of rental expenses that someone might have had. You can see insurance that you pay. You might have had some advertising costs to get a renter online. Office expenses is a tough one. Like, you can claim things like pencils or paper and small things that you might need for your rental expenses, but you don't operate an office as a rental office. That's how CRA looks at it, is saying, okay, you know what, are you a property manager? If you're a property manager that charges a monthly, you can deduct that there. But if you are not, and you're just a person, it's really tough to operate office expenses out of there, because you're not actually in the rental business. So that's something to often think about. We get asked that a lot. Professional fees, obviously, always included. Repairs and maintenance are often a tough one, because there's some things that improve the capital property. So things like siding, things like roofing, things that add to the structure of the building is what's called a capital cost. Then otherwise, things like toilets, mirrors, hey, you know, something broke, I got to repair this type of stuff. That's repairs and maintenance. You know, you might have someone who, you know, dirtied a carpet and you need to replace a carpet. That's repairs and maintenance. Travel, we often get asked about, unless you're traveling to somewhere, let's say like Nanaimo, and you need to go there to actually visit the tenant there, then you can deduct it. But if you're just driving back and forth to go see it occasionally, or you're driving by it, that can't be included with that. So it's knowing some of the rules around that and what the criteria is for that, which we can help with some of our Tower Group advisory services. So dividends, like I told you I was going to talk about in detail. People are often confused about what is a dividend. A dividend is actually a share of ownership in the company. So when you read this, you basically, a lot of companies pay that dividend in cash, or some of them pay the dividend in stock. So you hear about, TD Bank offers a dividend. That's a company offering it in stock, versus your company that you might have as a professional corporation or as a company, you actually pay yourself that in cash. What that is a share of your ownership. So if in fact, let's say you said, you know what, I'm going to pay myself 100% dividends instead of paying myself a salary, but then my business had a loss, you don't have a share of ownership because the company has no money. And so what you have to remember is accountants charge that against retained earnings, about the money that you made against that, where you are able to issue a dividend. So make sure you don't get caught in a situation where you have had a situation where you don't have income, or let's say all of a sudden you're retiring and pulling out some of the income. People are like, well, I could just pay myself in dividends. But if you have no retained earnings and you wore that all down, that becomes a catch-22 where you then become having a problem. So dividends are always a share of that. I always say to people too, like, people assume if you take $100,000 dividend out, it's $100,000. Know that all dividends for non-eligible corporations is 115% gross up. So if you take a $100,000 dividend, it's actually $115,000 dividend. So that's the gross up factor. So you pay income tax on the difference. So you always have to know that with dividends. There's also people that talk about the 15%. Well, dividends are only 15% tax. No, they're 15% grossed up. But the dividend rate used to be a lot lower than salary. And of course, Trudeau in the last 4 years, each year, or even last year, he chipped it up a bunch. So it's just actually under what a salary pays. So if in fact, you're saving yourself about 5% tax on a dividend versus otherwise. So don't assume that you're paying a way lower tax and this is great and for your money. It's not. And I think we often say to people, if you're very tax adverse, then maybe pay yourself that in a salary or learn to track it. Because people get confused of, why do I have all these dividends at the end of the year? And again, it's those people that haven't sat down and actually tracked it through the year of how much did I take out additionally, and did you need to take it? We had an accountant actually mention to us for this presentation, he's like, I have a client that, decided to buy a boat and a car because they had $100,000 sitting in there, and they were like, well, you know what, I'm going to use $100,000 for the car, but I'm also going to take out $100,000 for the boat. So then all of a sudden they had a $200,000 dividend, but they forgot about the dividend that they had to pay for their personal taxes, forgot about the dividend that they were paying for their RSP, plus the $100,000 dividend that they already took. So it's like all of a sudden they've got $400,000 almost in dividends, and they're going, well, what did this happen? And they did it in December when their year end was December, when they could have probably put that off until January and paid a whole lot less. And that's where we talk about people get in trouble with corporations and private corporations with causing what's called a snowball effect. And it's like, hey, could you have waited a month for that boat, or could you have waited a year or two for that boat and paid less income tax? That's something that we want people to really start thinking about with their planning is, do you really need to do that? And if we had insight at least every quarter as to what you've done, and a lot of people are like, I don't know, I'm just operating. And it's great that you're just operating your bank, but you have to know what you've taken, and we have to know what you've taken to actually plan for it for you, to also help the accountants know what you've taken. So sometimes it's best to always get that information quarterly to people.
Yeah, and even if it's just a simple note, your RSP, your personal tax payment, the reno, the travel, maybe those are things that you consciously chose. But if it adds up to $100,000, mentally, you need about 25 or 30% stored there for tax, right, in cash, so that it's not a shock and you're Kermit going crazy because it's like, where did this tax payable come from? Or, next tax season in April, you take that dividend out to pay it, right? Fine. But then, like you said, Pam, it kind of can roll forward year to year if you're not organized.
Yeah. So let me stop there, and I'll just pause for a minute. If anyone has any questions, you can enter them in the question category, or if you want to speak, Trish can unmute you and you can speak and ask a question if you have any questions up to this point on any of these things.
I have nothing at this point besides 9%. Why don't they pay interest if they owe me?
Exactly.
Exactly. We've got to feel exactly the same way. If anybody's inquiring on how the questions work, there's just a question tab at the bottom that you can go under questions and then enter your questions there.
Okay. Nothing else, Pam.
Okay, perfect.
Okay, so I'll go on to investment income. So investment income, and again, if you have questions throughout, please feel free to write them because we'll address them as we go here. Investment income, such as dividend income, these are always a surprise to people too, and they're like, am I expecting a T3 or T5? Always go back and look at your past returns or ask us where we're looking after your money, whether or not you have a T3, T5, or a gain loss report, because we can get all of that to you for your taxes. We always say, just like a dividend, when you pay yourself a dividend, keep that money aside for yourself. Like if you take 100 grand, know that dividend is probably going to cost you 25 or 30% tax, which means if you take out 100 grand, keep 70 for yourself, keep 30 for taxes. Just like that with capital gains and investment income, that money is not all yours. So you always want to make money on your money. And that's a great thing. If you're making money on your money, that's what you want to do. All of the portfolio managers try to manage gains against losses that they have so that you don't have to pay massive taxes. But if in fact you do, we always say keep 20 to 30% aside for tax, because of course that's not all yours. And I've often seen people, they sell homes or they sell property, land that they have, or sell something else that has a capital gain. And they spend all that money and then they're like, oh, I had to pay tax. And I'm like, yes, of course you had to pay tax. So make sure you keep that money aside against the losses. Again, you can, a really smart thing is, let's say you've changed accountants a couple times and you've lost track of some of your losses. If that actually doesn't come to the new accountant, the accountant can find it on your CRA site if you sign full authorization for them. But if you don't tell them, hey, you know what, I think I have a loss that carried forward, it may not trigger the accountants right away. And especially if they're rushing, they may not see those losses. And if you do taxes yourself, you may not catch those losses from former years. You can actually claim your gains against those losses. So make sure you always know what they are. You can find them on that my CRA, my account. They always track them there for you. And of course, know that if you've got a property or you've got stocks or you've got an investment account with us, capital gains rate change, as you probably saw in the budget, changes June 2024. So for people with personal corporations, private corporations, we've actually pulled some gain loss reports and are looking at what's called capital gains stripping to take out the capital gains before June 2024. That's going to be super important for people. And if you've got big portfolios that you want to start looking at, or let's say at your companies, you hold a lot of stock options or stock in your companies, good time to look at, can I actually take the profits now, pay 50%? On the personal side, it's $250,000 that's at the old tax rate of 50%. Then it's basically at the new rate of 66.67 above that 250 grand. So just make sure that if you have a property or something that's higher and you can take that profit, that you're going to take that profit before, or otherwise you're going to pay the highest tax capital gain rate that everyone's crying about right now.
Pam, we do have a question that was sent in previously here. I'll just read it out. What happens if you want to sell but don't remember a paperwork for what you bought for? How can you get this information, which I believe you've already touched on, but anything else that you want to touch base on that?
Yeah, like I think that's a big question that we often hear from people is, let's say they bought a Disney stock or a parent bought a stock way back when, and now they're 50 and they were 2 and they got it bought for them. If you bought it directly through the company, which some people do, and the company's been paying you dividends and everything else, every company has a shareholder registration and they can tell you how long you've been a shareholder for if you go through the shareholder payroll departments. A lot of companies, though, keep in mind, only keep 7 years of information handy, microfiched, available to them at their fingertips. So if you have to go back further, so if it was bought through a bank, the banks all have it. Most of the companies, if you had one company looking after it, can go back in their historical fiche, you will pay. So I know like TD, for example, like we've got a client in an audit and they are paying about $7 a month for them to go back. So if it was 20 years ago, 30 years ago, just know that you're going to be paying some fees to do that. Again, reason always to be organized, like always keep your paperwork on the buy sell, because that's your responsibility. It's not CRA's responsibility, and CRA usually will know. Sometimes the accountants can call and find out if they have information. Some of them don't, but all the companies use a company called CompuShare. So even if you wanted to start first with CompuShare, sometimes there's codes that companies want you to use, though, to look it up because it makes it easier for CompuShare. CompuShare keeps a shareholder registry of all the shares that people have ever had and where they were owned from, and et cetera, et cetera. That's what that company does. So basically they can go back and hopefully find it, but it is quite an exercise. And usually if they can come back with a year, you can usually do the average of that year. If they have nothing else, if the company's been through multiple mergers and multiple names, sometimes you can't find that. And you have to find the last merged company that you can find it to, and then the company back, and you have to try to do a manual calculation. And again, accountants will charge separate to do all of that because that's a ton of work.
So in that example, Pam, you're talking about a self-directed, non-registered, direct stock account. So in our non-registered accounts that you've got through us, obviously we've got all the tax information and all the record keeping. So it's just if you've got self-directed non-reg stock outside.
Prior, yeah, and that's always your responsibility. And that's why they call it self-directed, because you need to self-direct it yourself.
Yeah.
This is an example of just some credits that you can kind of use against your income. And again, we'll get into the various different credits that you can use. So you have your RSPs, you have things like deductions, again, for like CPP. You have things that I often say, and we're going to go through each one of these, but something like donations, and as well, we'll go through that and how that's changed over the last little while. So when you're at an income of 311,000, I would say, even if you're at any income, you want to take advantage of all tax credits, but especially at this income, you want to take advantage of as many credits as you can possibly get. And depending on your view of the government, sometimes people always say, hey, you know what? I like paying the government. They do great things with my money, and I'm fine with living in Canada, and they do great things as a country. So if you want to pay your money to the government, I know I pay too much to the government with my own salary. I will pay them nothing when I'm dead, and I will pay them nothing throughout this. So if you can use as many of your maximum credits, I would say do so. And then you actually are putting money in your own pocket as well as putting money in other people's pockets that can use that money more efficiently than the government. So when we talk about medical under tax credits, is most people, I notice, like if you have your own corporation, chances are you have a benefit plan, or you have what's called a medical reimbursement spending plan that you can reimburse yourself through. But always remember, no matter what, let's say if you have an individual and all of a sudden you've got kids with braces, you've got different expenses, we often see this missed a lot. Is let's say your plan, people go, hey, my plan covers me 80%. And I say, well, why didn't you claim the other 20% on your taxes? And they're like, oh, could I do that? Always claim that extra 20% that your plan doesn't cover on your taxes. If you have things like other prescription costs, dental treatments, orthodontics, let's say you need glasses, or even if you get sunglasses, Kelly did that last year, got sunglasses with prescription in them because he can't see, it's like that's all covered under your taxes. So utilize that if you need that to be done. And even Kelly and I had to have that conversation. I'm like, hey, if you can't see, get that done. You can deduct that. So why would you not? If you've got travel expenses that you incur for medical overseas or anywhere else, you can deduct those here too. And also the plan, like a lot of times people on their T4s are paying for their group plans. Some people, even with corporations, pay for a group plan. And it's like, hey, that group plan now can be deducted. Because if you're paying on your pay slip every single time for this plan, and it's $350 a month that they deduct off of you for your stuff, yeah, deduct that. Or sometimes people pay for an additional Blue Cross plan, deduct that. A lot of people go, where can I get that information for the 20%? Well, the insurance companies always calculate, here's what you claimed, here's what we paid. You can print that off for the whole year. You could also go to places like Shoppers Drug Mart, Safeway, Costco, that will print off, here's what you paid from us, here's what the insurance paid for, here's what you paid for out of pocket. And again, they can print that off from your account. It's so easy. So if you lose track of that and lose track of keeping track of that, make sure you just get that list and start doing it on an Excel spreadsheet. Kelly can also get you an Excel spreadsheet if you need one of how you break that out, but pretty easy. You can just follow how the insurance companies do it, because they do it exactly the right way. And that's something that you always want to keep track of for your account. Put it on your portal, of course. We often say, throughout the year for all these credits, so even if you make a donation, you do an RSP, you do anything, throw it in your portal throughout the year. That portal's always there for your accountant. So it's like, if you're having trouble staying organized and you're like, oh, I can never find my tax stuff, and you can't find a folder that you can just throw that tax stuff in, just scan it in and put it in your portal, and then it's there every single year, and then you can just go submit, and that's a pretty awesome feeling. I know I've been doing that, and it's great, and that's how you want to do it.
Whatever system you use, it's not a March or April thing for this example, right? Like those medical expenses that are out of pocket can be pooled for the whole household. And it's kind of like managing your tax file through the year. So if it's electronically stored or a hard copy folder, like do that through the year and add them up, because it can yield a material difference on tax payable or increase a refund.
And usually, another thing that I see is people have their kids do their own tax returns, which is great. But unless you're walking through some of the talking, like quick tax type programs that will walk you through each one of these credits, people are often like, oh, that takes too much time, I'm just going to rush it. I'm just going to put in my numbers and then I'm going to press send. I see that 90% of the time. So if you're debating on doing that with your child, that's usually what ends up coming out is, I don't have time, or they didn't have time, so we just put the numbers in. We didn't run through all the videos and run through all the things that you can do. Usually when people get into their first home, you can claim a $5,000 first home buyer's account. That is something that everyone misses that I've seen so far. Usually if you use an accountant and you say, hey, this is my first home I've ever had, because the accountants don't know whether you're renting, whether or not you were owning, you need to tell them, and you need to tell them when you move too, because there's now a home disclosure on your taxes. But you get $5,000 for free. Why would you not take it? And I think that's a great point that often is missed. Moving expenses. So again, a great point that's always missed with clients is they send their kids away overseas, or they send their kids to the States, or they send their kids. If you're going somewhere for work or for study, you can actually
if you move a province because of a job change is a common example.
Yeah. So anything for work or for study, you can actually claim those costs. So things like realty costs, setup of utilities, setup of rent, setup of all that stuff, you can then claim. If you had to travel out there, if you had to pay for airfare, if you had to do all of that kind of stuff, you had to look for places, you had to stay at a hotel, all that's claimable. So make sure that you're getting that information, because again, the accountant doesn't have it. So if you haven't forwarded it to your accountant, accountants can't read through all the tax credits, and that's why we're doing this presentation today, to kind of tell you the most important tax credits that you should be looking at. Tuition and education credits. Students have to claim what's called a T2202. It's on their student website. They can actually claim certain amounts, but anything that's what's called a carry forward amount, so over their income amounts, there's a carry forward amount. That carry forward surplus can actually go straight to their other people's. So just make sure that if you carry that forward, and let's say your parents paid it, you can then transfer it to your parents,
like
or you can transfer it to someone else for post-secondary education credits. So that's something to use. Or sometimes the family wants to claim it all, you can do that kind of thing, but CRA wants the student to claim the main amount. Charitable donations. Charitable donations are always great. And we often say if you're that 300 grand person, people often ask us, do I claim that through my corp or do I claim that personally? If you're an employee, you always are claiming it personally. If you have a corp, I might say you do both. And why I say that is because most people that we have that have corporations all have great incomes. What that does is it just helps you give that to a charity. And of course, any amounts now over $1,000 is actually taxed differently, where you actually get more. So if you're going to make big donations, make a bigger donation instead of actually giving it to the government. Make it to someone that you really like or someone that you want to be part of. Or even we have clients who set up charitable giving accounts. Now we can do that where you can direct your donations to wherever it goes, but it's in your name. And that's a neat way. What the government recently did is they changed the budget to say, okay, you know what, you can claim 80% of charitable donations on what's called your alternative minimum tax instead of that 50% they proposed. It used to be 100. So at the beginning of the year, it was 100, where if you passed away and you wanted to give all your donation money to, let's say that you owed in tax and you want to give it to a charity instead and have the charity cut you a receipt, you could claim 100%. Now they're saying, no, you have to still pay a minimum amount of tax and we'll take 80. So that was good. They were proposing 50 and it made a lot of the charities pretty upset. So they changed it before budget time, which is great. Maybe it'll be changed back. They're still getting a lot of pushback on that. RSP and spousal RSPs, put the money in your pocket before you ever pay any tax. And I have so many people that sometimes we have these conversations with. It's like, why would I do an RSP? Well, do you want to pay more tax? Because that's what you're doing and you're not putting it in your own pocket. So it often bewilders us, but we've done that calculation. It's like, if you're making 45% on your money, why would you not do it? Or even 30% on your money? That's the tax bracket differentials for most people. And so it's like, why would you not do it? Otherwise, if you owe tax, you end up putting it into their pocket instead of yours. That's always the smart thing. Know that your RSP is always 18% of your earned income up to that maximum cap, which is that 31,000, 31,600. Reduce taxes as a caregiver. If you care for an eligible dependent or child, someone that might be disabled, or let's say they just need your help, you can actually explore tax breaks. So things that you actually do for them, medical expenses, you may pay for them, renovations to your home for that type of stuff, it's all claimable now. So make sure that you can look at that kind of stuff and we can go through it and determine what's eligible to be written off. Childcare expenses, we always say there's a bit of confusion around that, but the lowest income tax provider in your family, so if one makes 100, one makes 50, the $50,000 person is actually claiming the childcare expenses. That's how the Tax Act works. You can't claim it on the higher income spouse, you just can't. A lot of people too are like, well, you know, we're both working full time, can we deduct our nanny? Yes. Oh no, my wife's now going to stay at home with the nanny? No. So just know that if you're paying for childcare while you're actually at home, you can't deduct any of those childcare expenses because you're at home. So it must be only while you're going to school or you're going to work and having both of you work. And again, deductible at marginal tax rates.
Yeah, it's up to, of that lower income spouse, it's up to 2/3 of that person's earned income. And under age 7, it's a max of $8,000. To age 16, it's $5,000 for childcare expenses. But those are another one that you just have a folder, electronic or hard copy. Otherwise, keep those expenses because they make a material difference on your tax return.
Fantastic. Claim education and training costs. So people often ask, hey, you know what, I'm going to school. If you're going to school, some of those school expenses can be claimed through your corporation. If it's to actually get a personal degree, they now allow you for a degree for training, diploma, or a certificate course, they allow you to claim $250 from 2001 forward. So you can actually claim similar to an RESP this year and the year prior. So if you have a $5,000 cost, let's say, hey, look at those balloons. Guess if you give a peace symbol, it gives you balloons. That's new to me. Anyway, very fun. So they like that credit, apparently. If you're doing some education, just make sure that you can deduct that. A lot of people are saying, well, I just want to go on a medical course. Well, write that off through your company. Don't actually pay for that individually. If you're actually going on a course that has nothing to do with your career and you're an individual, it has to have something to do with your career or allow you to get a career somewhere else if you're unemployed. So that's how they look at it as an eligibility thing, is making sure that you're investing in your own skills. Carrying charges. A lot of people ask, hey, why is the Tower Group not being able to be written off fully? You can write off some investment costs. I know Newport always offsets the cost. Some firms don't offset the cost with it. So you can only deduct interest too. Like, let's say some people have taken out loans and said, you know, I want to buy this stock. I'm going to take out this loan, I'm going to buy this stock, I'm going to hit it big, and I'm going to write off all the interest. You can't do it on capital gains. You could only do it on interest or dividends. So there's a fallacy out there that people think that you can leverage to buy different kinds of companies and stuff like that. You cannot, and write off the interest. So they say that's actually like gains and losses can go up and down. So they're like, you're not actually making business income. Business income is only if there's a dividend or interest income. Should we pause here and see if there's any other questions so far? Am I doing well? I'm 3 minutes to finishing this session, and I think we've got probably about 10 minutes worth of slides. So if you need to jump off, then jump off at any point. Working from home. Do we have any questions yet, Trish?
I do. I have 3 just popped in. So kind of related, you can get a grant through the Alberta Job Grant if you want to do any professional development. Will they pay 2/3 of the fees?
If it's a job grant, I'm not sure. I'd have to actually look that up and get back to you on that one.
Yeah, just reach out to us directly and we'll coordinate an answer.
Yep.
Okay. Can you deduct a nanny if both parents are working, but one of the parents work from home full time?
Yeah, if you've got earned income, whether it's a hybrid work situation there for sure, up to those limits. So yes, absolutely.
Yeah.
Okay. And can I write off the interest from an RSP loan?
No,
Oh.
because the growth in that RSP is already a tax break on your tax return and there's no taxable growth from it.
Okay, that's what I have right now, guys. That's what's come in.
Great questions, everybody. Thanks so much. That's so great. So work from home. I always say pants optional, even though I have pants on, but it's always just a funny thing that people talk about that on the news still. People don't wear any pants and they get caught on meetings. So I had to put that in. Home office expenses, of course, with COVID ended last year. So for 2023, if you actually work hybrid from home, you actually need a proper form from your employer that they filled out to say, hey, you're eligible to work from home. You can't just assume that you're eligible to work from home. You actually have to have that form to say, I'm eligible to work from home. Here's the expenses that I, require you to pay as an employer. So like for someone like Trish, she works from home. I have to fill out what she has to pay. So of course it's like, there might be some things that she could pay for herself. She can also claim her home. So when people often ask, hey, you know what, I've got let's say a medical practice downtown and I'm operating mainly on all my patients out of that medical practice, but I'm also working from home. Can I claim both? And it's like, if you pay for that medical clinic or you pay a stipend each month for your medical presence in that clinic, you cannot deduct both. You can only claim one. And that's the same with any corporation, same thing, you can claim one. If you're an employee, you're claiming your home and still saying, you know what, that's the 10%. We always say 10% of your home. If it ends up being 15, they can include it in a calculation when you sell your home. So we always say stay 10% or under of your home expenses. And it has to be work-related activities at that place. So sometimes people claim their kitchen, and it's like, as long as most of your work-related activities can be justified from there, and that's where you may see your employer, you may see everybody else, then deduct that. But you can only deduct 10% of your home. Rent, mortgage interest, utilities, property taxes, maintenance costs. People often ask, I get tons of questions on blinds. Can I claim blinds? You can't claim them for your whole house, but you can claim them for that office. So if your blinds keep bugging you, then, get them fixed, get them replaced.
So if you're an employee, you're working partly from home and you want to engage your employer in this conversation and say, like, is this relevant? Is there a conditions of employment form, a T2200 relevant to this situation. And then it'll be clear on that form how to submit and then provide to your accountant.
Yeah. And there may be other employment expenses like paper, pens you have to buy, or let's say, you know, you might travel to an event that you need to be traveling for your employer. Make sure that they're filling that out, that you need to travel to these events for that employer. You need to deliver things for your employer. That's all vehicle expenses and all, you know, looking at stuff around, hey, what other expenses do you incur to do that? Review taxes with your family. So this is a big one. And again, I'll let Kelly talk to most of this. I tend to see people, like whether it's taxes or an executor, they're like, no, I don't want to tell my family anything. And you know, my parents' generation, let's say, always had a tough time talking to family about stuff. And the more you review this and talk to your family about stuff that's happening, they can then help you with your estate, or they can help you with tax, because sometimes younger people or people that are our age are a little more savvy with some of the tax stuff than, let's say, some of our parents used to be. And there's been so many things that have changed. Get involved with that and say, you know, how can I help? Or you see people who just love their people and they're like, oh, you know, they're 92 like me, and they haven't been really employed in an office for 30 years, but they're doing it as my friend, and it's a nightmare. So, and they're not registered and they don't know the due tax rules. And you know, we've often seen some of it where you just go, what? Like, why are they doing that? And that's important to always check and do that.
So I'll keep this quick, and we can then talk in person individually. We're also going to come up with more tools later this year related to all of this. But using your tax return as a tool to better understand it yourself, because it's not just reviewing it prior to filing, it's when you get it returned back to you and looking through those schedules. It's useful to do that. And then if you are empowered by some of that knowledge that we can help you with, take that to your adult kids. You know, and that promotes good conversation, especially if they're your executor. And so then it's like, okay, here's the conversation, or here are the people that you need to reach to, here's the binder, here's the information, right? You know, and then that's, you know, you can see the breakdown of a person's investment accounts or where they conduct their business through those tax returns. I think it's an amazing tool to also relate to your parents, for example, which may be, you know, they may be 60 to 100. And so that conversation, if you're the executor in their situation, or if we can give them a second opinion to help you make sure that they go through that checklist, and we can help them just to make sure everything's covered off. A lot of times we find mislabeled beneficiaries where it's not properly structured. So a tax return, if your parents provide that to you, or a connection to their accountant, can be a tool for really good conversation. And I've often done that, and there's 3 that we're doing again this week, where we're sending this material to a client and they're sharing it with their elderly parents as well as their siblings to have good conversation. So I think that can be a huge tool. But for now, we'll move on to that next slide, and we'll continue that dialogue in person and in future conversations. So tracking your stats, you know, maybe this is for our more detailed individuals, but I find a lot of people get excited if we can kind of gamify the situation or your goals or your progress, or I'm constantly being asked about milestones and benchmarking against peers, which I kind of see it more as an individual household thing. But if you then break down your tax return and you say, okay, here's the line item for my total income, and then total tax paid, because after a lot of the deductions from your taxable income or the credits from your tax payable, and you can see what's reduced those amounts, I find it interesting to say, okay, here's the percentage overall of the tax that I actually paid based on total income. What is that as a percentage? And then it's interesting to me to say, okay, well, let's take a look at your total savings across the different platforms. What is the total savings that you have in your household against total income as well as net income? Some people look at their lifestyle expenses as well, saying, okay, well, what is most appropriate based on either my total income or my net income for certain categories in their lifestyle expenses, and they break that apart. because we definitely believe you should be living your minimally acceptable lifestyle, not minimum, but minimally acceptable. And a lot of times people increase their travel allowance or certain big purchases. So if we can use, a pie chart or helping you calculate your percentages based on certain amounts, it can make it more of a fun game. But definitely tracking your stats using your tax return as a starting point can be a fun conversation, especially if it's between spouses or helping with kids, etc. And a lot of times what we find is when we're dealing with, we often have clients that are the elderly parents, then the clients that are 45 to 50, and now their children are 20 to 30. All through that household, we have clients and we help them with the communication between that. And that's where this can be a really cool tool. It's like, yeah, absolutely. Let's take a certain percentage for fun money. And what does that look like? Because if you're living at home and you're still going to post-secondary, obviously, and you're working a bunch, obviously you've got a huge capacity for savings. But talking to elderly parents, sometimes they feel pinched because no one's ever given them a forecast and shown them what's free to spend. And it kills me if a person's mom can't go to the mall and feel like they can, buy a new sweater or take that bus trip or have a family vacation and bring all the family to them. So there absolutely is a certain percentage that you should be applying to fun and family and leisure, etc. But this method is just a different perspective, and it starts with your tax return because you can pay less tax if you use a lot of those strategies and deductions.
Absolutely. Thanks, Kelly. So how do you use your refund? And again, Kelly, you can talk to this too, but lump sum to mortgage, that is always my favorite. So someone always asks me, that's actually how I paid off my own mortgage. So when I had a mortgage, every single year, if I got a tax return, which wasn't a lot of years, but I did get tax returns at the beginning of my career. And, you can pay down that every single time you get a tax return. Just consider it not yours. People are like, oh, I'm going to pay it towards this, or I'm going to use it for a holiday. And I'm like, don't, because that's free money you've already paid to the government. So it's a tax credit. Take it, put it against your mortgage. Every single time, it's never your money. Just look at it as it's never your money. Or, and I always do those calculations for people is I can show you what that'll save you on your mortgage, and you'll be flabbergasted at how much lump sums actually work towards paying down your mortgage so quickly. Like you can do it in 5 years where it was a 15-year amortization. So, it's really fun to do that. We can help you fund that. We can even say, like we have people right now that are funding TFSAs and putting in GACs at 5% because their mortgage is 3%. And then when it comes due in 2 years or 3 years, then they're going to pay that lump sum all down on the mortgage right then, because they paid down other lump sums. Then you finish it off, which is fantastic.
Yeah, and I think in May, tax returns done, you can check that portal. You see next year's room, make sure your TFSA room is topped up. And that also would show on your tax return too in terms of carry forward room. But if you get a large tax refund, it isn't someone else's money that you got as a bonus. It's your own money back. And so if you had a huge refund and this is your normal year and you're an employee, you can actually go back and ask for your employer to reduce less, take off less tax per month so that you have more each month to go then and pre-authorize to savings, for example.
And things like obviously your RSP, we obviously say do. Some people have been asking, how can I help my kids? Well, you know what? If they're working or let's say they're at their last couple of years in university, this new first-time home buyers account that you can do $8,000 a year to is fantastic. So, if you really you've maxed your RSPs, you've done your TFSAs that you want to do for yourself, I will say, look after yourself too, because it's great. A lot of people really put a lot of money towards their kids, and it's great that you do that, but don't forget about yourself, because then all of a sudden your kid's 30 and you're going, wow, I can't retire because I put too much on my kids. So make sure that, if that's your other resort, just kind of saying, okay, you know what, I've done all the things that I've needed to do for me. I'm now going to put it towards my kid every year. That $8,000 will make a huge difference for their taxes. They can do that for 5 years for that $40,000.
Yeah, and if you've got carry forward RSP room, obviously that might be the first look, and you catch up on that, or you do this year's RSP. It does not make much sense, hardly for anybody, to wait until Jan Feb. We do it through the year and do it early, and a lot of times we're just covering out off in May. But yeah, I think we can move on to the next slide.
So we asked 7 accountants that we deal with certain clients. We asked 7 accountants what they wished that their clients would do better. And it's also something that we see all the time as well. Number one, we didn't put on here, but like provide all your information, which means check your mail, check your CRA portal. We talked about that 3 or 4 times a year. Have your accountant's portal, like if you get notifications and it's something that's a little odd, or let's say it's, hey, you're 10 days late on this, here's a payment, get that to your accountant so that they have a track of it, because otherwise they may not be getting the tracks of it. Most accountants don't, of billings and stuff like that. So they'll get notice of assessments. They'll sometimes, and even the last 4 years, they haven't got notice of assessments for some people. So make sure you send all of that as soon as you get it. Load it up into your accountant's portal and just let them know, hey, I got my notice of assessment. Then they can check and make sure it's all correct as well, because sometimes it's not. And you have to know the difference. And sometimes people just get it and shuffle it away and don't really look at it, that they owe $200, and then all of a sudden that's getting penalties and interest. Don't do that. So, that's a big thing. When you get all your information, make sure you cross-reference it to previous years and kind of say, okay, you know what, I had a T3 this year, I should have a T3 again, or the bank gave me interest on that money, but I used it for a house and I already know that in my brain, then you're not going to probably get that same slip anymore from the bank. Those are the kind of things you just need to think about, or even talk to us about, and we'll tell you, oh yeah, you got one, you won't have one this year. And I think just comparing your former tax return to this tax return is super important. Review a draft before it's filed. So a lot of people go through that DocuSign and go next, 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 sign. And then they come back and they're like, oh, the accountant got my address wrong. And I'm like, well, did you enter it on CRA? Well, no, I didn't know I had to. Well, can the accountant not change that? I'm like, no, they can't. You have to change it at CRA. Oh, well, my birth date is wrong and my income was wrong. Check it, because you know what, everybody's human. So as much as I'd love to say all accountants do a great job, I've seen mistakes out of every single accountant that people use.
Or I had a baby and you
Yes.
didn't tell you, like the accountant is going to file based on information you provide, and that where it needs to be complete, and that baby will help you on your tax return because you get different deduction credits and features.
Yes, and make sure you talk to them, I've moved, because of course you now have to disclose real estate purchases. Real estate purchases right now is the #1 audit feature for CRA. And number 2, like we had on that other slide, was bloggers. So kids all of a sudden now who are blogging and being social media darlings, and they get sent shoes. Well, you have to claim that on your tax return now. So knowing those kind of things is really important, and having that conversation with us as planners and the accountants is important, because we'll go to the accountant and go, they have income that we have to claim now. A lot of people just think, oh, isn't that great? They're getting shoes sent to them, because we've got 3 clients who are doing that right now with their kids, that they're getting sent shoes. And that's claimable because the company's writing it off. So, those kind of things, it's not so great. And if you're ignoring it and not claiming it, that's again a non-disclosure. So knowing stuff that it's like, hey, if I'm getting stuff for free from companies, chances are it's not free.
Yeah, so we won't spend too much more time on this, but the perspective was to your benefit, what could you know or do or make sure that you're on. So for example, if you've got your own company and there's draws that are being taken from different lump sums through your bookkeeping that you're providing to the accountant, make sure it's well noted. And then like we've been talking about is like have a list of your draws or your dividends or the special amounts that you've taken out. Sometimes, like you said, people are fallible, Pam, but unless it's really noted there, a couple clients have noticed it's like, okay, well, they classified this as a personal dividend when in fact this was business related travel. And so it's cross-referencing that and noting that forming good communication with us and your accounting team to make sure that your tax returns are optimized if we can try to attain that goal. So let's move on to the next slide, or the last slide.
Yeah, and I think everybody kind of knows this stuff from what we talked about with everything else. So I think that's the biggest thing. And the other one thing that we had come up in the last couple of weeks is from 3 accountants is kids sometimes are assumed free. And even though an accountant might charge you under your corporate return for your own personal return, every person is a separate entity. So if all of a sudden you now add your 3 kids, all 3 kids are going to get charged for, because just like, I look at somebody like H&R Block. We tested this year to see how much they were charging personally for a tax return. Just because we always do comparison as to, hey, what's happening out there in the world. Even they are charging $150 to $175 for personal tax returns, and Liberty Tax is charging even more. So you can't assume that kids are free through us, through the accountant. We take on kids initially and get them kind of going, and the Tower Group has never charged a fee right off the bat. But if the kids all of a sudden have been with us 1 or 2 years and all of a sudden they're in their career, they're just like everybody else that would have to pay a personal growth fee. They're not free.
Yeah, I think it comes down to communication too. Like the accountant should be saying, okay, well, this is what the cost will be as a kind of a quote, but they're assuming it's self-explanatory. Like if that child's got income and there's T slips and there's RESP slips and there's TFSA room and RSP room and there's time taken, sure, it makes sense. And I do believe that, it's not so much about price, but getting good value. And so how you can get good value too is they're always open to having a meeting. Like we'll always do everything we can do and help liaise and coordinate and improve communication with your professionals, such as your accounting team. But we do believe there should be an accountant. And a lot of misconceptions, sometimes people say, well, I'm not complicated enough to have an accountant, and that's not necessarily true. It is true that most of them won't take just personal files, but if we can get a good accountant filing for you and your whole family, even just the reassessment, and if there's communications and Q&A that the government comes back with, the time saved by having that team respond is hugely valuable. And then we can also, use your tax return to provide good lessons to everybody in the household. And I think we'll move on with that. So I think that's huge. But Trish, we'll just check in with you to see if there's any ongoing questions.
I have one left. It goes back to the work from home slide. Can internet costs be deducted on taxes if you work from home primarily?
So if you don't have another office, right, and you've got your own company and it's a self-employment expense, then absolutely, of course, obviously. If you're an employee and they're asking you to pay for certain expenses and cell phones and that kind of thing, you almost have to pre-clear it with your employer to say, okay, does a conditions of employment form cover what we're doing here? And I don't know if you have anything to add there, Pam.
Yeah, because the basic thing is when you answer yes on that form, I need my employee to pay certain expenses. Like even I go back to Trish and say, hey, you're paying for this and this and this and this and this, because it's like, Trish manages a lot of those costs herself. And that's what's really great about our office is she even orders our papers. So, it's like, an office is willing to do that. It has no skin off of our backs whatsoever. And it's like, if she has to pay for her own paper on the Tower Group, that's fine. We pay for it. But maybe she needs to pay for something else like internet that's in her house. Of course she has to pay for that. She has to have Wi-Fi, and it's not something that, let's say, most companies cover. So yes, you would have that claimable, but yes, again, your employer has to fill out that form. Same thing with, hey, I need, cell phones unless they pay for your cell phone, or a computer unless they pay for your computer. So that's all defined on those forms. So definitely usually internet is one of those costs for sure.
Yeah, it's a long answer, but yes, likely, for a portion along with other expenses if approved.
Yep. And if you haven't had enough of this session, I guess if that's the only question, unless there's more questions that come in here, but if you haven't had enough of this session and you want to watch it 6 more times, go to our YouTube page, like and follow us and subscribe. And I'm going to do this, and maybe a hand will come up, or maybe it won't.
Fireworks?
Oh, there we go. If you could subscribe to our channel, you'll get notifications of all of our videos that go up there. So over the year, we're going to have more and more videos. We're going to be doing this once a month. Thank you to the clients who responded for topics, because we've got actually topics now until mid next year for topics. So all of your topics are
Yeah,
heard, and we're dealing with each single topic that people want to hear about in webinars, because you all told us you love these. So
Well, I
thanks very
appreciate
much.
your time and attention and attendance, because usually it's like 2 thumbs down for like taxes. So we tried to make it fun. Everybody, have a great day and a good week. Thank you again.
Bye.